Hi, my name is Thomas and I work in the Households and National Accounts team at the Reserve Bank of Australia. This video is a brief summary of current economic conditions as published in our Statement of Monetary Policy on the 5th of February. The recovery in the Australian economy is well underway and has progressed faster than RBA staff had previously expected, supported by Australia's relatively better health outcomes, the removal of restrictions on activity, and expansionary fiscal and monetary policy. Despite positive economic news over recent months, the next stage of the recovery remains uncertain and is expected to be uneven. Before I talk more about domestic developments, let's take a look overseas. There's been a resurgence of COVID-19 cases since late last year. This chart shows COVID-19 hospitalisations relative to population size in selected countries. In many countries, hospitalisations have surged and surpassed their earlier peaks in April 2020. Consequently, social distancing restrictions and lockdowns were tightened and extended. For some countries, these have been almost as restrictive as in the initial wave of the pandemic in April last year and are likely to remain in place for some time. More positively, though, a number of vaccines have been approved and some countries have started vaccinations. The rollout of vaccination programs should reduce the spread of the virus and limit the need for restrictions, but just how quickly this occurs will depend on the speed of production and distribution of the vaccines themselves. The resurgence in infections and tightening in restrictions in many overseas countries has dampened economic activity around the turn of the year. This chart shows our gross domestic product, or GDP, changed in many countries during 2020. The red dots show the extraordinarily large contractions in GDP that occurred during the first half of 2020. The golden squares then show how much of that initial decline was recovered by the end of September. By this time, and in fact even earlier, by the end of June, the Chinese economy had already recovered to be above its pre-pandemic level of GDP. The blue arrows then show how GDP has progressed to the end of 2020. For some places where December quarter data is not yet available, forecasts have been used in this chart, including for Australia. In countries where the arrows point up, GDP has recovered further since the end of September. However, you can see in this chart that several of the arrows are pointing down or are still pretty close to those golden squares. The economic recovery in these countries, which are mainly in Europe, has stalled or reversed alongside the resurgence in cases. Even though lockdown measures are as strict as they were earlier in 2020 in some places, the impact on GDP should be much smaller this time around. One way you can see this is that the blue arrows are not expected to fall back down to the red dots for any of the countries here. This is because new lockdowns have been more targeted than the earlier ones, and because households and businesses have adapted to carry on more economic activity under lockdown conditions. This has been made possible in part by the increased availability of personal protective equipment, such as face masks, compared to earlier in the pandemic. Turning to Australia now, the recovery in GDP has continued in December, getting back closer to, but not all the way back to the pre-pandemic level of activity. Australia did have some smaller outbreaks of COVID-19 in recent months, such as the Northern Beaches cluster in Sydney. Information from the RBA's Business Liaison Program suggests these have led to only modest or temporary reductions in household spending. Let's look a little closer at households then. This chart shows the level of household consumption in blue and household income in pink. The data to the right of the line are forecasts. As with GDP, household consumption is not expected to have recovered back to its pre-pandemic level at the end of last year. This is because some types of spending, including some services, were still restricted by social distancing. In contrast, spending on many goods have increased since the beginning of the pandemic, particularly online goods. On the other hand, we can see something quite different going on in this chart when we look at the household income line, especially in 2020. Despite the fall in GDP, households' disposable income actually increased. Income was boosted in particular by government support measures such as JobKeeper and increased social assistance payments. Because income increased and consumption fell, the household saving ratio rose sharply in 2020. A large share of the decline in consumption was due to lockdowns in limiting opportunities to spend, but in part it was also a response to risks posed by the virus and the uncertainty that people have felt about the future. The additional savings that households have built up between April and September from that higher saving rate amounts to around $200 billion, which is around 15% of households' pre-pandemic annual income. But this boost to household income from fiscal policy support has mostly been temporary by design. As this support comes to an end over coming months, disposable income is expected to fall. These policies have shored up households' incomes at a time when a large number of people were at risk of losing their jobs. This has allowed households' key source of income, employment, some time to recover. Let's turn then to the labour market. This chart shows employment by status. A full-time employment in red is shown on the left, and part-time employment in blue is on the right. Notice the scales for the left and right start at different points. Both full-time employment and part-time employment have increased since June by 280,000 people alone in the last 3 months of 2020. Recent increases reflected a rebound in Victoria as it recovered from the extended lockdown in Melbourne. The initial decline in part-time employment was very large. This happened because employees in industries affected the most by social distancing restrictions, such as accommodation and food industries, were more likely to be part-time employees. Part-time employment has since increased to around pre-pandemic levels. The fall in full-time employment was a bit smaller than part-time, but in contrast, it's still far below its pre-pandemic level. There were around 125,000 fewer full-time employees in December 2020 compared to February earlier. Overall, the recovery in employment has progressed faster than expected, and employment is expected to continue increasing, especially as data like job advertisements and vacancies continue to improve. In the near term, though, the end of JobKeeper in March creates some uncertainty around the pace of growth. Despite the positive outlook, this large gap in full-time employment and other indicators tell us that the labour market still has significant spare capacity to absorb. Let's turn our attention now to consumer price inflation, shown in this chart. The line here shows inflation over the year, and the bars show inflation over the quarter. Movements in inflation have been dominated by COVID-19, which has caused inflation to move around a lot more than usual. Looking past these pandemic-related movements, underlying inflationary pressures remain low, and inflation is below the RBA's 2 to 3% target range. One reason for this is that wages growth remains very weak. Many employers, including governments, respond to the pandemic by delaying annual wage reviews and previously agreed increases. Rises in the award wage were also delayed into early 2021. In light of the spare capacity in the labour market and subdued inflationary pressures, monetary policy is very expansionary. The Reserve Bank's policy package from November 2020 is working broadly as expected and is helping to support jobs. Borrowing costs are low, and the banking system is equipped to provide the lending needed to fund the economic recovery. In addition to this, at its February 2021 meeting, the Reserve Bank Board announced a further $100 billion of government bond purchases, or $5 billion each week, to begin when the current schedule of purchases ends in April. In a recent speech, Governor Lowe stated that the government bond purchases have helped to lower interest rates and contributed to a lower value of the Australian dollar than otherwise. The target for the cash rate, yield target for the 3-year Australian government bonds, and the rate and funding allowances available under the Term Funding Facility were all left unchanged. In terms of forward guidance, Governor Lowe noted that the Reserve Bank Board will not increase the cash rate target until actual inflation is sustainably within the RBA's 2 to 3% target range. For this to occur, stronger wages growth is needed, and this will require further significant increases in employment. The board does not expect these conditions to be met until 2024 at the earliest. For further details on the RBA's monetary policy, see links in the description. Like monetary policy, fiscal policy is also very expansionary. This chart shows the combined cash balance of federal and state governments as a share of GDP. This measures how much revenue the government sector collected, mostly through taxes, minus how much it spends. If a government spends more than it collects, that's deficit. The opposite is a surplus. So to the right of the line here are budget forecasts for the next few years from state and federal government budgets. The size and change in the cash balance is a simple way to measure the fiscal impact or the impact of fiscal policy on economic activity. You can see that in 2020-21, the combined deficit is expected to increase to just under 15% of GDP, reflecting an extraordinary amount of fiscal support during this period. The budgets project that the deficit will become smaller over the next few years. Over this period, state and federal governments are still spending though. In particular, public investment is expected to increase. A key uncertainty for the economy going forward is how households and businesses will adapt to the tapering of some of the temporary support measures over the coming months, like JobKeeper. So I've talked a bit about economic developments now. Let's talk about the outlook going forward. This chart shows the RBA staff forecasts for GDP over the next few years. The baseline scenario, the solid line, assumes no further large and lengthy outbreaks of COVID-19 within Australia, that the vaccination program proceeds in line with government guidance, and that international borders remain closed until the end of 2021. In the baseline scenario, GDP recovers to its December 2019 level around the middle of 2021. This is about 6 to 12 months earlier than forecast 3 months ago, and that's largely because the economy has recovered more quickly than anticipated in recent economic data. Nevertheless, within the forecast period, GDP is not expected to catch up to what it might have been had the pandemic never happened. Largely, this is because population is expected to grow at its slowest rate since the First World War in 2021. There are also some scenarios for what could happen to GDP if things turn out a little bit better or worse than expected. These scenarios have been included in recent statements because the future is more uncertain than normal. Under these scenarios, GDP could recover by a bit more or a bit less than the baseline forecast. The progress made on GDP in these scenarios then affects the forecast for the unemployment rate, shown here on the left. In all scenarios, spare capacity in the labour market is expected to remain such that inflation, shown on the right, remains below the 2 to 3% target range. Growth in wages is similarly forecast to be low. These forecasts remind us that the economic effects of the pandemic will be felt for some time. The Reserve Bank will continue to support the economy as it recovers from the pandemic. Thanks for listening.